Yeah, and some people use that.
Okay, let's go ahead and get started. Good afternoon, everyone. Thank you for joining us for this panel on succession planning and employee ownership. My name is Jamie Schenker-Passaro. I'm the Director of Programs for the Temple Small Business Development Center. We help small businesses start and grow, and we do this via our no-cost consulting and through our training programs like the one you are attending today. So regardless of your industry or where you are in your business journey, we have a lot of services to help you. We have a legal clinic, we have digital marketing assistance that includes SEO audits. We have a lot of exciting programs. We have business planning classes, and I can share some links for our resources, our website, our event calendar in the chat. For today, you know what you're here for: succession planning and employee ownership. This is an important topic, whether you are a little bit further down the line in your business journey or you're starting out and you just want to have a plan. It's good to have a plan. Joining us today, we have Scott Moon, the Executive Director of the Baker Center of Excellence. We have Tony Parisi, an investment banker with SEA, David Mills, Senior Vice President at WSFS, and John Churchill, a bank's business strategist at WSFS as well. So who wants to kick us off to start this afternoon's panel?
Jamie, I think I was elected to bat lead off.
That sounds great. And then since we are in the webinar format, I think our panelists today welcome questions to come in as we go. So I will look at the chat, but the Q&A is honestly the easiest, more efficient way to get the questions answered. So if you can pop them in the Q&A, that's even better. But yeah, feel free to just to do that as questions arise. And if you would like to, it would be great to have you all the participants use the chat to let us know, let the panelists know, let me know more about your business, and maybe where you are in the succession planning journey. So feel free to use that at your leisure, and I will hand it off to our panel.
Thanks, Jamie. And so we'll just look to you for questions as they pop up if we're not reading something. So my name is Tony Parisi. I'm an investment banker with Strategic Exit Advisors, and we help entrepreneurs sell their businesses. Our niche is just that, working with entrepreneur-owned companies. Sometimes the companies are family-owned generational businesses, sometimes not. We know that the sale of a business for an entrepreneur is probably the most important financial transaction of that entrepreneur's life and perhaps of the family's life. And so we take that very seriously, and we take that we customize our approach and our focus to work with entrepreneurs. We know that entrepreneurs have very significant emotions around the company that they built. There are real priorities around preserving culture, making sure that a prospective buyer and partner is a culture fit, that the values of the business and the people are going to be honored, that the employees are going to be in a good position with good opportunities going forward. And that is all very personal for an entrepreneur who's used to having control of the process or control of the business. And so what we do is we focus a lot on that emotional side, if you will, of selling a business in concert with the process itself and the numbers, which always have to make sense. So we will help entrepreneurs get ready to sell a business, and we will also and then we'll get in and actually execute on that sale process. So that's our focus. That's who we are at SEA. I know that today our focus, kind of our purpose as a group, is to have a much more kind of agnostic, multi-approach discussion. We respect that. We realize that selling a business to a strategic or financial buyer is just one option. And so when we get to know prospective clients, we go through that in detail. And if we're the right fit, then we love to help. But I think, we as a firm and as individuals have these conversations, build our relationships with a sense of gratitude to get brought into these very important businesses, and with a sense of making sure that we're the right fit, and a sense of a belief in abundance that life's not a zero-sum game, and if there's if somebody's a fit for us, then great for us to provide services. If we can make a referral to somebody so that they can evaluate other options too, then that what's best for our client, and our relationship is what's best for us. So with that kind of, I hope, opening of the door to more than just being about sell side representation, I think, Scott, I'm passing the baton to you, right?
Perfect. Tony, thank you so much. So my name is Scott Moon, as Jamie introduced me. Thank you, Jamie, first off, for you and the rest of the folks at the Temple SBDC for hosting this event today. I'm the Executive Director of the Baker Center of Excellence for Employee Ownership. We are based out of Montgomery County Community College up in Bluebell. The center is fairly new in the employee ownership landscape. We were founded in 2021, and our mission is really to be the community hub for employee ownership and support inclusive growth for employee-owned companies, for their employees, and the community at large. There are really three pillars of our offering, or how we support the market. First thing we do is provide education on employee ownership and related topics, and that's both to employee-owned companies and those that are just interested in employee ownership. We participate in initiatives that create awareness for employee ownership. In fact, today I was up participating in a press event in Harrisburg for some new legislation that we can talk about that's going to support employee ownership. We also host networking and opportunity sharing events that support the broader employee ownership community. And so, our mission is really to educate, create awareness, and provide support and be the conduit between employee-owned companies. Just to sort of set the stage that we see in the marketplace, put some context around the discussion. There's been some national research really focused primarily in the area that we're interested in. And we see somewhere between 2.5 and 4 million businesses are expected to change hands over the next 10 years. And that's really driven by the aging of America. There are folks like to talk about the baby boomers who've had such a significant impact on the economy. Many of them started businesses or took over family businesses, but those businesses are going to have to, those baby boomers are going to age out of running those businesses, and ultimately there needs to be some succession plan put in place. And we'll talk about all the various options that are available to those individuals today, but specifically, I do my best to advocate for consideration of the employee-owned option. It's an important issue for a number of reasons, and we can go into greater detail of that, but we have certainly seen benefits across three major stakeholders for those who take an employee ownership approach. For companies, there's research that shows that employee ownership companies are more productive than their non-employee owned counterparts. As a result, they are able to compensate their employees at a higher level. They typically experience less turnover, and they perform better during slower economic times, including the most recent pandemic. And there's lots of data out of the National Center for Employee Ownership to support that. What tends to get a lot of press is actually the benefits for employees. As I mentioned before, you typically see employee-owned companies pay their employees higher because they can. But what's really interesting is you see the retirement accounts of the employees of employee-owned companies are significantly greater than their non-employee-owned counterparts. And we can go into detail about that. And then on sort of the softer side, there are surveys that show that employees of employee-owned companies typically have greater job satisfaction, and they stay with their companies much longer than you find with non-employee-owned companies. So, and lastly, for communities, there are some tremendous benefits as well, and that's sort of why politicians, both on all sides, Republicans and Democrats tend to get behind employee ownership as an approach. Typically, companies are more stable. They provide a tax base to communities, and you tend to see companies that are just much more involved in a positive way in their communities. So we'll talk more about that, but you'll hear from me sort of as an advocate for the employee ownership side of this. So, John?
Beautiful. Thanks, Scott. So my name is John Churchill, and I lead WSFS Bank / Bryn Mawr Trust efforts to advise our business owner clients who are contemplating some form of ownership transition. We've talked about, transition to key employees. We've talked, another option is, of course, transition to family or transition to an external buyer, whether a strategic buyer, someone else in a similar industry, or to a financial sponsor, typically private equity or a family office. WSFS Bank basically diagnosed an issue a couple of years ago, which was, we were getting, calls from business owner clients who more or less had announced that they were selling their business, but hadn't done any pre-preparation in order to prepare themselves, either prepare their business to go to market or to prepare themselves financially to exit. And I tend to focus on both sides of that house or that equation. But one of the biggest issues that we've diagnosed is that business owners are frequently focused on the top line number, how much money that they achieved in an exit. And they're less focused on how much they get to keep personally. So that's the bulk of my work is trying to get in early with business owner clients and advise them how to do that how to exit in the most efficient way possible. And of course, through WSFS Bank, which is the largest locally owned and headquartered bank in the region, is still a true community bank. We like to, have our executives know our clients and have opportunities to meet with them, whereas at larger national banks, maybe the headquarters is hundreds or thousands of miles away. So we basically made the decision that I would be a client amenity. So any WSFS client can come in and meet with me. Anywhere ranging from someone who owns a medical practice to someone who owns, a large, multinational corporation. So, we're here. We're very interested to speak to our business owner clients. And with that, let me introduce the commercial side of WSFS with Dave Mills.
Thank you, John. And thank you as well, Jamie, for hosting us for this panel discussion. I'm David Mills. I'm with WSFS Bank. So now that you've met us, you can call us WSFS rather than WSFS and save a couple syllables. Hopefully you've gotten to know us the last few years in the Philly market. We bought Beneficial Bank a little over 3 years ago, and then earlier this year bought Bryn Mawr Trust. So together, the three of us were the three largest locally headquartered banks. Together, we're by far still the largest locally headquartered bank with over 20 billion in assets. I'm in our commercial banking group that provides financing to small and mid-sized businesses in the greater Philadelphia area. I've been doing it for a long time, well over 30 years. I have the gray hair to show for it, I guess. But my role is to advise business owners on their options to manage their succession of the ownership, whether it's to family members or key managers, or to sell the business to others. And then get involved in providing whatever financing makes sense, either for the buyer, whether it's family, management, or even potentially to private equity or strategic buyers, and advise them on the available capital to fund that exit as appropriate. I've also worked with the ESOP community or employee ownership community that Scott represents, and have a fair amount of experience with that. So I'll be here to talk more about those options for available financing, and to talk about just the different sources of funding towards whatever exit you might want to pursue, depending on your wants and needs. So with that, I think, Scott, we were going to try to hit on a couple topics and raise some questions for us
Sure.
to touch on. Is that right?
Yeah, I think we're kind of in the spot. Didn't we? We were going to kind of each go around and
Yeah.
share a bit about the process and working with clients and so forth. Do
Yeah,
you want to
go
go in the same order, or Scott, do you want to go first this time, or?
Yeah, I'm happy to go. I'm happy to go first. And so what I can do is what I'd like to do is really just a lot of people have they understand or they're familiar with the concept of employee ownership. A couple things. Employee ownership can take a number of different forms. From probably, there's certainly the ESOP, the employee stock ownership plan, which we can talk about, and I can share that. There are offshoots of that. There's there's a structure called a worker cooperative, which is typically appropriate for smaller businesses that are looking for a very egalitarian approach. There's another offshoot of the ESOP called the ESOP Trust, which is sort of an ESOP without as much oversight and administrative work that's typically required. And then you'll also see employee ownership approaches where there are employees who owned components of a company through various equity type programs that exist out there, or partnership type programs. And so I think the concept of employee ownership can take a number of different forms, and the appropriate form for any given company is a function of the size of the company, the objectives of the company, in some cases the industry that the company is in, and what's considered common in that industry, and so forth. So I think there's been some very interesting developments in the topic of employee ownership. Even to the point where we've seen very large private equity firms looking to increase the level of employee ownership in the investments that they make. So I think that what I find really interesting is that there are a number of different parties kind of getting on the employee ownership bandwagon, and they see that it can create businesses, or it can create opportunities for their businesses, and then ultimately the shareholders or other shareholders who may not be employees. What I thought I might do is actually really briefly just kind of go through an ESOP structure, because that's the one that tends to get a lot of interest by companies. And so the first question is sort of what's the appropriate type of company that might be eligible for an ESOP? Well, typically when we look across the ESOP community, we see examples in a variety of industries. We see them in manufacturing, distribution, professional services, consumer products, financial services. There's in the Delaware Valley or the Philadelphia area, and certainly across Pennsylvania, there's some very high profile companies that actually have an employee ownership structure. The one that comes to mind, the four of us or the five of us here sit in Philadelphia, but Wawa has a very significant employee ownership component. And if you walk into their stores, you'll see the badges on their employees say associates. But all of those individuals are employee owners.
I did not know that.
Yeah, the family sold about 47% of the company to the employees a number of years ago. The Sheets, another really well-known convenience store, has a very large employee ownership component to it. On a national level, the largest, well, I guess prior to the recent announcement of Albertsons, Public Supermarkets, who many of you are aware of, is a fully employee-owned company. And so, it's for companies that but there are many companies probably that you've never heard of. So I would say on the low end of the spectrum, it's typically companies that have at least 10 million in revenue and about 20 to 25 employees. And again, that's kind of the low end of the spectrum, and it goes up from there. It's typically companies that have, I would call it they've already determined that they have a successful business model. They are generating profits. They are able to support the financial transaction. ESOPs are not a turnaround strategy, nor are they a startup strategy. They are a succession strategy, and I make a big distinction there. And so, we can talk about that in a little bit greater detail. I'm going to do my best to try to share my screen, because I put together a very short and simple graphic of what an ESOP might look like. So hopefully folks can see this, but there are basically 5 major parties, if you will, in a leveraged ESOP transaction. And this is where, let's just say the founder decides that he or she is ready to sell the business. They determine that selling the business to the employees is the best approach, or the approach that they want to take for a variety of reasons. And so what they end up doing. So we have the founder, we have an entity called the ESOP Trust, which is effectively the entity that holds the shares that are owned by the employees. We have the company itself, which is the entity that's going to be driving revenue, getting expenses, and creating profits. Then we have the employees. And then lastly, we have the bank, which is providing financing for the ESOP. So it's pretty straightforward. What happens is the owner or the founder decides to sell the company. They typically sell all or a portion of their stock, and they receive cash or a note from the ESOP Trust. Part of that transaction, the ESOP Trust typically needs some financing to execute that transaction. So they'll take a loan from a bank. The company, on an ongoing basis, is generating revenue. They have expenses, they get profits. They take the excess profits and they provide contributions into the ESOP Trust that pay either notes to the founders or payments back to the bank, and in many cases, both. And that process can go on for a number of years. A founder can sell all of their stock or just a portion of their stock. What's really interesting about these leveraged, these transactions is they're very tax efficient. And without going into too much detail, an owner is able to structure this transaction so the sale of this stock can actually defer or get rid of all the capital gain tax, all the capital the capital gains associated with that can either be tax deferred or pay zero capital gains on that on a federal level. The company is able to deduct the contributions they're making to pay back those notes, so that can reduce their taxable income. And then from the employee's perspective, once they either retire or separate from the company, they sell back their shares, which they've received through an allocation process from the trust. And they're able to drop the proceeds of the sale of those shares into an IRA, further deferring the tax liability associated with receiving those funds. So what are the big benefits to an ESOP? One, it can be very tax efficient for the founder, the company, and the employee. Two, it allows the employee to generate significant retirement assets. And three, it can allow the company founder to sort of continue the cultural and some of the softer objectives they might have when they're selling their company. So that's sort of a quick overview of what an ESOP might look like. We tried to simplify that. I'm sure David and John and Tony have worked on structures that are much more complicated than that. But we tried to simplify that. The other piece that I might add, which is actually two comments. Number one, we're seeing companies that use the ESOP structure, not just, and the founder might still want to stay involved in the company. So what the founder might do is sell their shares in tranches. So as I said, they don't have to sell 100% of the company at any one time. They can do it they can sell portions of the company over time. And what we found with certain companies is they view that actually as a way to drive additional growth and performance in their organization. You put the shares in the hands of the employees are then feel a much greater sense of ownership. They tend to drive, their performance is driven faster, they sell more, they manage expenses better, all those good things that happens with companies. And ultimately that can drive higher valuations in companies over a longer period of time. And it also allows the founder to stay involved in the company and still participate in the equity on an ongoing basis. So that's one piece. The other piece we begin to see is companies are using ESOPs as a way to fund an acquisition strategy. So today, in certain industries, it's becoming common for a roll-up strategy to happen. So I would say it's happening in the HVAC industry today. So we all have like the local electrician. Well, those local electricians are all individual owners. And what we're seeing in the marketplace today is some very large companies are coming in, many of them employee owned, who are then rolling up through acquisition, a number of these sort of either HVAC servicers, electricians, other type of trades, and using the ESOP structure as a mechanism to buy the companies, but also keep the employees and the acquired employees very, very engaged on an ongoing basis. So just a couple things to think about. And I would be remiss if I did not mention that October is National Employee Ownership Month. So we all who are work for employee-owned companies need to do our best to
What a
raise-
celebration.
Exactly. So thank you, Jamie, for helping us schedule something during Employee Ownership Month.
Yeah, it's a good thing for our business clients to know about, to know that it's even a possibility.
Yeah.
But you want me to jump in here, Dave, or do you want to go?
Well, I thought it would be good for Tony and John to talk about the planning phase of preparing for this. And frankly, I think all too often, and Tony and John can attest to this, business owners don't prepare early enough for a ownership succession plan.
Right.
So maybe talk about what you've observed and what are some of the best practices, and then I can get into a review of the different exit strategies or succession options available to companies and provide those highlights, but maybe talk with the planning aspect of it first. Tony,
Sure.
do you want to start? Yeah.
So,
John.
I'm sorry, is it Tony's turn?
Yeah, go ahead, John.
Go ahead. Go
No,
ahead.
go Tony. You're good.
You-
Sorry.
Go ahead.
No,
Before
well,
you sound
I
like
just,
those two little chipmunks from the old Bugs Bunny movies. You go ahead, John, please.
okay. Well, one of the, the sort of rationales for ESOPs that we frequently see, and Scott touched a little bit on this in talking about, roll-up strategies, but one of the terrific things that ESOPs provide is an alternative market for the shares of the business owner, right? So if there isn't a, when you start to talk about a business that's, in that, above $10 million, range, revenue, I guess you would say the market of potential buyers is somewhat narrow because it may be too large for a sort of classic management buyout where, let's say you have, a terrific layer of management underneath the owner who are all, really good at what they do and, could bring the business forward, but maybe they don't have personal financial wherewithal to actually buy in a classic, management buyout, or, for whatever reason, they disqualify using SBA funding to go in and buy, the business. So, ESOPs aren't always the sort of first address, but it's a great solution once you've sort of, I guess, gone through a process of, disqualifying other potential avenues that are typically a little bit easier and maybe, in some cases more remunerative. So for example, why are HVAC companies, construction companies, there aren't the financial sponsors out there, the private equity firms at the same degree that perhaps other companies, a widget manufacturer, or most recently, medical practices have a lot of private equity money that's looking for deals. In HVAC companies, it's not typically, or at least historically, has not been a juicy target for private equity. So to create this alternative market for the owner's shares, while also, if you think about the trades, it's apprenticeship business. So you have, really close relationships between the owner and their key employees. They want to take care of them, or perhaps all of the employees. Because again, in many cases, these employees have been working at these companies for, 10, 20, 30 years. How do you take care of them is near and dear to many of these owners' hearts. So, Tony.
Great, thanks. Well, I'm gonna put up a graphic, kind of a infographic that we use with folks as we're getting to know them, as I talk about a few things. So thinking about the M&A market right now, and specifically for us, I would say that 80% of our clients own businesses that are worth between probably $7 and $25 million. We have some bigger clients we're working with. We have some smaller clients that are below that level, but that's typically where we play. And the market continues to be robust in terms of buyers for those size companies, most of which are companies with EBITDA of over $1 million, $1.5 million. And there are corporate buyers, public companies, private companies. There are private equity backed companies that are consolidating. And then there are private equity businesses that'll buy a given business as a first investment in an industry. There's a diversity of different kinds of buyers. There are multiple different types of private equity groups that have different objectives and priorities. So there are a lot of options out there. Buyers are typically looking for high quality businesses that have sustainable business models that are capable of managing risk. Buyers are discerning and risk averse in this environment. When there are real quality businesses that have differentiation and growth, buyers are very aggressive in the market. So in terms of why a business owner sells their business and goes through a sell side process, typically they're going to get the highest value compared to some other options. They're going to have flexibility in terms of their ongoing role. They're going to be able to move out of the business sooner rather than later. They won't have to continue to guarantee debt. They're going to be likely to be able to sell more of their business earlier. And there are employee ownership opportunities when a business owner sells their business to a strategic buyer. Usually a buyer will come in and say, we're going to provide options, stock options for some of your employees going forward. So those are the main reasons that we see people undertake M&A as a plan for going forward. And with our building value roadmap here, this is really about creating a vision and a process for success that embodies what the owner is looking to do, what's important to them. We do this in concert with a group of trusted advisors, hopefully a wealth advisor, an M&A experienced M&A attorney, an accounting and financial advisor who can be supportive in the process. And how we get to know clients is we go through this readiness assessment and value assessment that's in the upper left-hand corner here. And what we come up with through some diagnostic work and financial review is a range of value and identifying value gaps. We may be working with an owner who is 100% ready to sell. We may be working with an owner who's open to selling in the near term or waiting. And we may not be working with an owner who knows, I don't think I'm going to be ready to sell for a year or 3 years. If our analysis and our work with the client leads us to a place where we say there's real work you could do to improve your value over the next year, 3 years, then we'll go through what we call our readiness roadmap. We'll identify where there are value gaps between where the company is today and where they could grow the company into and do improvement work. And we'll take them through that process over a period of time. And when the company is in better shape to sell with better value, we'll go into a sales process. In other situation, the owner is 100% ready to sell, and/or the owner's flexible as to timing, and we do our work and we say, you could go to market right now if you'd like, and here's what our approach would be. And so we go through that, and then we would go through this top path here where you go right to selling now. And in terms of that sales process, and that could be another webinar, of course, but we spend a lot of time with our clients, understanding their priorities, who they are interested in selling to based on their ideas and our ideas, who they don't want to sell to. And then we calibrate the release of confidential information, starting with getting non-disclosure agreements from prospective buyers signed. And we have face-to-face meetings very early with prospective buyers and our clients so that we can make this a real tangible experience. And the other thing it does is for prospective buyers, getting face time with our clients early on really ups the energy of the process. And in a world where buyers are looking at many acquisitions, our client's the one where they've had contact early on, where they understand what our client's priorities are and what they're trying to achieve in a deal. And that puts the buyers on a seller footing to convince our clients just why they're the best partner for them. So there's a lot that's kind of embodied in this pictograph here. And our role and our timing of our role really depends on where our clients are and what their priorities are and what they're looking to do, building that, creating that vision, understanding it, and then building a process that's going to get us there.
Tony, actually, would you go back and reshare that slide if you don't mind? Because your process is in many ways very complementary to what we do. So just in terms of looking at the value gap analysis, another big piece of this that we would recommend is typically ordering a valuation of the business in order to set a baseline of value, right? And there are a couple different types of valuations, but typically what you're talking about is a fair market valuation. And what that fair market valuation does is it also establishes, sort of the baseline of what the business may command in the market. And Tony's job is to go out there and make the market. But the other piece is that it can also inform a retirement analysis. So especially when you're talking about smaller businesses, it may be the case that it may be premature to sell because whatever the ultimate take home for the business owner may ultimately be, may be too small to fund 10, 20, 30 years of retirement. So that's another important piece from the perspective of the owner to actually know or have a better sense of how much they will take home personally from executing the deal and whether or not it makes sense to begin the process of sort of improving the value of the business in order to sell in a short period of time. The other thing that it can do is if you've made that analysis and you're coming up short, it's not enough money to retire, you would work with advisors like Tony, advisors like myself, in order to drive value and get you to a more concrete place where that if you sell this business, you're going to be able to retire comfortably in whatever lifestyle you've grown, you and your family have grown accustomed to. So it's I really like this slide, Tony, and we should do more work together.
And I'll add some commentary to that. According to our research, over 80% of business owners have not done any of this at all. No plan in terms of succession, no valuation analysis, no estate planning, no nothing. And if there's a message we can convey to each of you is to consult advisors to begin to think about it. And we all work with business owners and they're going 100 miles an hour running their business and trying to make it successful, but they have to plan for succession sometime along the way. It's really important because all too often it can be too late. when they decide to do it. So would encourage you to do that planning with your advisors well ahead of time.
Yeah, I mean, as you probably can tell, all of us are more than happy to, would welcome the opportunity to talk with anybody. We were meeting today. I mean, I think we've had around 50 referrals this year, and we're working with, I think, 7 or 8 clients right now. So we're in the business of having conversations and helping if we can and pointing people in the right direction as well. And having that idea of where you need to be is really important. And there's a lot of reluctance to kind of get into this stuff because it emotionally, it can be hard to think about what's next and what you're going to do the day after you sell a business. And those are the types of questions that we ask so that you don't get into a process and then you agree to a deal and then our client says, oh no, what's really going to happen the day after I sell my business. And you can get taken unawares. I mean, we have clients who get unsolicited offers who we work with, and we had a client last year, and he had an offer, and it was about 4.5 times cash flow. And we kind of looked at it with him, and he said, well, I want 5, and we kind of looked at it and said, you should be getting 6 to 7. That's really where the market is. And if your business is as special as you think, you might do better than that. And he signed us up because he couldn't get to that 5 number with the person with the buyer that had reached out. We went through a process. We got 4 offers between 6 and 7 times, and we got one at 9.5 times. So we ended up taking the 9.5 time one, and he got more out of the deal than he would have, after tax than he would have gotten pre-tax for the 5X deal he wanted. People are coming from different places. The more you're prepared and you work with people, advisors, build that trusted advisors group, the more options you're going to have. Building that vision is a big piece of it.
So Tony, if you could stop sharing your screen, I'd like to share my screen, and we have a slide that I think highlights those trusted advisors we're referring to. Let's see if I can get this up here. Do you see that?
Sure can.
Yeah, so you can see here some of the key advisors we recommend you engage with if you haven't already so Tony's here, the investment banker. John and I are here. So this is really your banker that could advise on the options available to you, and if there's financing required to help arrange that. You also want to consult your wealth advisor. We also offer advisory services through John and Wiswis Wealth and Bryn Mawr Trust to prepare your individual situation for receiving, the liquidity event if that results from your succession or whatever estate planning is needed. You want to talk to your CPA firm and your accountant about all things involved in tax and otherwise. You want to have an attorney, 2 attorneys. One is a corporate attorney that's familiar with M&A transaction and business ownership succession and can advise you on those legal aspects. And then you want to have an estate attorney to advise you on the ownership transition if it's among generations within the family. So that just highlights some of the advisors we recommend you engage with early and often regarding this topic.
Absolutely. And
I thought, guys, since we've touched on already a couple of the different options available for business ownership succession, I thought I'd go through and provide an overview of each of the available options and provide some comments, kind of the pros and cons of each. And maybe I'll lead it off and we can all chip in with some comments on each. So let me go back to those slides. So the first and probably the most popular one is transitioning your business to your family, to your children, typically. And that could be done through gifting over time or, through an estate sale upon death. or through a sale to the family members or some combination thereof. That's quite often how it happens. So there you preserve the continuity among the family. There's less disruption, less costly. That's the advantage. But the disadvantage is you're not going to get maximum value for your company, typically in that case, because your children can't afford to pay you, presumably for full value for the full business. So you're typically gifting a lot of the shares. And frankly, your children may not really be the right people to run that business in the next generation. So you have to really make honest assessments of that and determine if you want to do just a straight transition to family members or children. The second option is to sell to your management team that maybe aren't family members, but are actively running the business. And that's a pretty popular option as well. There's continuity with the business. The management team remains in place. They're going to be even more motivated now that they'll become owners. And that can be very popular. And you can get a decent price for that, but not maximum price for that. The cons are those buyers typically aren't that wealthy and can't afford to pay a top price for that, or they can't afford to borrow enough from a bank to pay the price you'd like to get for it. So it tends to lower the valuation you might realize in a sale. So you end up, if you want to sell it fully, you're going to have to take back what we call a seller note and finance a lot of it, and more than you would otherwise in selling to somebody else. But that can be very popular if you have a loyal management that is interested in becoming owners. Then you get into a sale to an ESOP that Scott talked about in greater detail. That is a very tax efficient way to sell your business. Both there's a way to avoid or rather not avoid, but defer capital gains on the sale. And then the business itself, if it's 100% ESOP, the way the ERISA laws work, typically can become tax-free in terms of having to pay income tax going forward if it's 100% ESOP. So there's some tax advantages for being in ownership. But the biggest advantage is your employers become owners. Your employees rather become owners. Those shares are typically issued over time, typically over 10 years. So it's not immediate, but over time they become owners. And as Scott touched on, they become much more engaged and motivated and productive. And there are statistics out there now, and Scott can share them, that employee-owned businesses are more productive and more valuable as a result. And from a banking lending standpoint, there's a lower failure rate as well for ESOP or employee-owned businesses. It is a more complicated structure, but the good news is all the professionals involved in those transactions have become a lot more conversant on the structure in the last, I'd say, 10 years, including bankers and accountants and attorneys. So you have professionals like that are here today that understand the structure and can help you navigate through the complexities and make it workable. Perhaps the one drawback I see primarily, and this is really something that you face 10 to 15 years later, is eventually you have to repurchase the shares from employees that receive those shares, but when they retire, pass away, or leave, there's an obligation to repurchase those shares. Quite often it occurs over 5 years, but still there's an obligation to purchase them. And it's not something you can readily manage like you can if you own shares privately, and you can kind of negotiate when you buy them back. So that's something that has to be addressed down the road, but that's typically at least 10 to 15 years or beyond. And then there's the sale of your business to a third party, whether it's to a strategic buyer, i.e. a competitor, or somebody else that wants to get into your industry, or to private equity funds. And this is where professionals like Tony are expert in helping you navigate through that, manage that process, prepare a company with a professional presentation, and get you maximum value, and then handle all the negotiations with those buyers that, believe me, you don't want to necessarily handle personally. It's too tricky. You typically can get the best value or price for your business pursuing that option. And if you want to maximize your cash and be able to walk away, then that quite often is the best option. But it can be a pretty involved process. It can be distracting. It can be emotional for you. If, you may or may not have control of the legacy of that company once you're gone, as much as you'd like to. So it has some drawbacks as well. And then the other option is to maybe not sell the entire company, but if you want to at least diversify some of your wealth that right now is tied up mostly in your business, you could sell a portion of the business either to a third party or do what we would call a recap or a dividend recap, where the company could pay a special dividend or special dividend or buy back shares into treasury and take away some of your ownership, give you some cash that you can turn on, invest in something else and diversify your ownership. That can be done with debt, typically with banks, again, or other investors like private equity. So that can be a good option if you want to do a staged transition of ownership over time. And then back on the third party sales, I mean, I don't know whether people want to get into whether it's a private equity versus strategic buyer. I think Tony could speak to that. There are some differences in the type of buyer that we can get into. Do we want to do that, Tony? Touch on that?
Well, yeah, I mean, I think what I would say about this page, and thanks for this, I think it nicely lays out. Looking at we run processes that create opportunities and alternatives for both that sale to the third party and also the majority buyout where the owner retains some equity. We had a client whose business we helped sell in 2020, and he sold 70% of the business. He stayed in it. He was fortunate in terms of the company he sold to, and that 30% with what's happening in his industry is probably gonna be worth as much as the cash that he sold the 70% for. However, when we are working with people, we were conservative about that, and a big piece of it is it has to fit with what the owner wants. The cons to selling to a third party, the process timing, the distraction, privacy, emotion, the complexity. I think those to different degrees are considerations in each of these options. Even with an ESOP, we would tell people when we're starting to go to market, we'll say, plan for a 9-month process, and we're going to be working on a 6-month timeline. Having advisors help really run the process for the owner is going to enable the owner and managers to continue to operate the business, which is a really important thing to do during a process so that you're continuing to grow and generate your numbers. Privacy, I think, is an issue anytime you're sharing information, even within the company. So again, we try to calibrate that, but you're going to be sharing information. The emotions, the complexity, again, it's part of the picture, and it really gets back to doing some real serious thinking for our client, for the owner, around what do you really want to do and do now and do next, and why, and taking into account all your advisors and your partners and your spouses and your family members. What's that next chapter of your life going to look like, and what's the best ways for you to get there?
Right.
I had a question, guys. I'm really, first of all, I love the way that you've laid out the various options, David. Thank you so much. I think it's a really good sort of overview of everything. But I'm curious, we've seen a lot of volatility in financial markets over the last couple of years, right? Asset values coming out of the pandemic went through the roof. And then we've then we saw it go the other direction. As interest rates began to rise, economic uncertainty became a thing. I'm curious what you're seeing in the market today, both in terms of asset values, and then secondly, in terms of approaches companies are taking in financing, given what's going on with interest rates today.
Yeah,
I could speak to the availability of financing and all of that, but I would say, why don't I have Tony and John speak to valuations of companies and where it's trended recently, especially with the increasing rates. Do you guys want to touch on company valuation trends first, and then I'll talk about financing availability?
Tony probably makes you
Sure.
start, and then I'll clean up.
Yeah, if we look at public valuations, we all know where those are going based on our monthly statements that we try not to open. Public markets have been very difficult. On the private side, buyers are discerning. They want to buy quality businesses. They want to avoid buying risk businesses where they see risk. In our side of the market, kind of that sub $50 million valuation, buyers are typically not putting a lot of equity, or excuse me, a lot of debt into their deals, to the point where if interest rates go up by even a percentage point, 2 percentage point, it really knocks the ice cream off their cone. The deal can still work. I would say where interest rate and industry dynamics are most relevant is in evaluating the seller's business. To what extent are they relying on new homes being built, or the price increases that they've been able to take through because supply chains has been constricted. Those types of things. I would say we more see buyers analyzing that taking the kind of macro issues in evaluating the quality and the price and the risks related to our client rather than capital structure. And I'll also say, I think one of the great trends in M&A over the last 20 years is that these questions of culture and priorities for the owner are very much part of the conversation from the get-go. I wanted to make that point. For those of us who've Dave and I worked at Core States Bank, was probably 25, 30 years ago, and you had core values, but it was kind of, it felt so mechanical. And I think what everybody realizes is that the best way to screw up an M&A deal is to have a bad culture fit, bad values fit. And so in this day, it's really a great thing that buyers are cognizant of culture and values and wanting it to be a fit with the acquisition company, and company owners are cognizant of that too when they go into the business. Everybody's focused on that, and it really makes for a better process and a more sustainable business, which is a big part of what we're talking about here. More upside for people, a better fit, and a better chance of success. So sorry to go a little bit off target, but I think that's an important point to make. But in terms of those macro trends, that's where we see them having the most impact.
Okay.
And so a couple of comments. So the canary in the coal mine for the direction that we're headed is the financing of early stage companies, in some cases pre-revenue, right? And so if you look at first, let's talk about the ones that are earning some revenue that over the past couple of years have been the hottest stocks have been typically technology companies. A good example is Uber. Tremendous growth, but it doesn't at the end of the day make money, right? So on the much earlier end of the spectrum, it's become very difficult for startup, business owners to find financing, venture capital financing. Venture capital was basically developed for companies that aren't bankable yet. They can't get, traditional bank financing because they're not profitable yet. So on that, end of the spectrum, the amount of money going into venture capital investments right now has slimmed down significantly. And as Tony, mentioned, when you're looking at, companies that do make money that may, attract private equity investor, and potential buyers, the issue that they're facing is that, there is a flight to quality. So, Tony earlier in the conversation mentioned that, some companies that are earning $1 million of EBITDA have attracted private equity buyers over the past couple of years. Historically, the sort of limitation was, a minimum EBITDA of 5 million, right? And that has trended, lower and lower. A couple of years ago, it was 2.5. Then occasionally you're hearing 1, where private equity is interested because the competition for deals is so fierce that they need to go downstream. And what you may see over the next couple of years, depending on how long the current environment lasts or how much it deteriorates, you may see that EBITDA limitation trickle back up, go up from 1 million to 2.5, or if it gets really bad, potentially all the way up to 5. The other thing that you're seeing in terms of the types of private equity opportunities that some of the business owners that we work with are seeing is essentially the deal terms are becoming more stringent. So, less cash up front, more cash preserved in what's called an earnout period. So the earnout period is essentially, you must hit key benchmarks for, typically 18 months, sometimes as long as a couple of years, in order to get, the full amount that you've signed a term sheet for, right? So, that's the environment that we're in. I'm still seeing mostly valuations hold up, and I don't know if you agree or disagree, Tony, but I am seeing more stringent deal terms, certainly over the past 4 or 5 months, whenever our business owner clients are being entertained by private equity.
Yeah, it depends. I think your point about buyers are risk averse and they'll build in. We try not to use the E word, earnout, around here, but and when we have clients look at deals that have earnouts in them, we're typically discounting those. So if we have two offers and one's for 12 million and it's basically a cash deal, the one with the earnout, if there's potential for a $2 million earnout and the owner feels good about that and the cash part of the price is 11.5, then that might be a good option. If the cash price is 10.5 and there's a $2 million earnout, you're likely to look at that, depending on the terms of the earnout, look at the cash price and kind of say, bird in hand. I definitely agree that buyers are looking to contain risk, and earnouts and other structuring are one way to manage that.
Right. Maybe I'll just wrap up the discussion on value to touch on some of the key drivers, I think, of value and where the trends are. And I'm going to quickly share my screen on this. And I'll give credit to John for putting this slide together. But, here's highlighted below are some of the key, drivers of value that we think most buyers are looking at, these professional buyers. And by and large, the expected rate of growth of the business is the biggest driver of value, or at least of multiples of, of EBITDA, for example. So whether you achieve that through, organic growth or, market share gains, or profit margin expansion. If you can make a compelling case that that's going to continue to happen, that'll drive your value. Certainly, the bigger the company, they tend to command higher valuations. There's kind of rules of thumb when you reach certain levels of EBITDA, your multiple expands, your valuation multiples expand. Tony, I don't know what the cutoffs are now. I know 5 million and 10 million, it seems like there's an inflection point where your valuation multiples go up a little bit in size. Certainly, the more diversified your customer base is, or long-standing the customer base is, the more recurring your revenue stream is, those are all factors that are going to help support and drive your value. I would say right now, in my view, there's downward pressure on valuations, and we'll see whether that actually materializes. It's downward on two fronts. Primarily, one is concerns about the economy and the growth rates being sustained, and what potentially is a recession we're going into or already in some cases, depending on how you define it. And I think rising rates, while 1 or 2 percentage points increase in rate or percent increase in rate is not too significant. We're now at 3% higher in rates. Short-term rates, or it's called the prime rate, has gone from 3.25% to 6.25% in less than a year. And the Fed's meeting next Wednesday, the consensus is they may raise the Fed funds target rate and thus the prime rate by up to 3/4. So we may be looking at a 7% prime rate next week. That's beginning to have an impact on the cost of debt. It has an impact on the discount rate you use to do your discounted cash flow valuation of a business. So it's going to put some downward pressure. Although, as John and Tony alluded to, there's so much money out there looking to invest in businesses, both from private equity as well as pretty liquid corporate buyers. It's going to sustain values, I think, but there's certainly downward pressure where we stand today, more than there was even a couple months ago, in my view. Same with availability of financing. Banks are still very liquid and well capitalized, but their cost of debt has gone up. It's still relatively cheap historically if you look back 20 plus years, but it's higher now than it was only 6 or 9 months ago. And I would say banks are beginning to look at and underwriting loans with a lens of concern about the economy. So if your business is cyclical and may be impacted by a downward cycle in the economy, that's a discussion you'll have to have, and that may impact the availability of debt. But overall, it's still out there. It's been very plentiful for a number of years, other than the COVID impact for those that were impacted by that. But I would say it's been a good borrower's market and seller's market for a number of years, but we might be at a point where it's getting more challenged, is my overall assessment of things.
The point that David, you and John have made on the kind of the hopping in point for buyers and private equity, there are definitely different layers. You get to 5 million, you get to 10 million, you're expanding your universe of potential buyers, and you're getting some expansion of multiples when you're selling your business. That said, there are a lot of private equity groups that might say you have to have $10 million in EBITDA, but if the private equity group, I'm looking at an add-on acquisition to an existing portfolio company, that company only needs to be at $1 million in EBITDA. So you see that a lot. And I think that the list you put together on what impacts value is really, really good. I think one of the things to mention that hasn't come up is for a business owner preparing to sell, one of the best things you can do is to start to develop your company and your people so that you're detaching yourself from the vital operations of the business. If an owner is vital to ongoing sales, that's going to mean that they have less options in selling their business because they're connected to their clients and the sales process is reliant on the owner, compared to a situation where the owner's over time is more in the background, and really making sure that there's a sales and marketing operation, a repeatable process that's gonna run with limited impact, limited direct participation of the owner. The more you can get out of that kind of personality of the owner being a big part of the franchise and the brand and the operation and the sales, and the more you can move to the owner working on the business rather than in the business, when it's time to sell, when it's time to do any type of a transaction, you're going to have more alternatives as an owner.
I agree.
I'm really glad you said that, Tony. I actually have recently encountered a company that has gone through an investment banking process, and it's not with you. The investment banker involved did them a disservice because there's no layer of management underneath the two co-owners that could run the business in the absence of these owners. And the process has not gone well. They've not gotten, offers, and they've decided to withdraw the company from being for sale. But they still have a very long fee tail if someone were to pop up and want to buy them, where the investment bank that did them a disservice would be owed something if they did sell. So it's also, I'm worth saying again, I'm really glad that you mentioned that, because not every investment bank out there or business broker will provide that kind of advice, and they'll just take a company to market, hope they can throw it up on the wall and see what sticks, and it ends up with a bad outcome for the business owner. So thank you.
Yeah, it's important to understand, ask those questions, and again, it's really around understanding your client, I think, for all of us, and understanding their goals and building a vision of how to get there and creating as many alternatives as possible.
One thing that I always like to ask, and you started the process, it's you either want to provide, what are best practices, or what are the two things you don't want to do? So maybe I can throw that out to the three of you and say, so if you're looking to sell your businesses, what are either two things you absolutely must do, or two things you absolutely shouldn't do when you're thinking about selling your business?
Well, from our standpoint, and we're based in Philly, and we're there's 6 of us in our firm. I should have mentioned that. We're privately held. We're kind of entrepreneurs ourselves in that respect. But from our perspective, we always say, if you're not running a process, then you're in somebody else's process. So you get that unsolicited bid, which is happening all the time now, that unsolicited inquiry, and you get into a cadence where you're just giving information to a prospective buyer. Now you're in their process, and they may say, oh, I want to get under exclusivity, or even, okay, I'll get back to you, and they're on their timeline. Having an advisor, and obviously this is what we do for a living, so we believe we do a good job in advocating for our clients in this regard, is creating a process that buyers are working in at the direction of a seller and their investment bank, their advisors. So I would say getting into somebody else's process is, especially through kind of an unsolicited offer, is really a dangerous and kind of stagnating thing to have happen. And I'd say the other thing is, selling a business without having that vision of what you're going to do next can make things really complicated and lead to a lot of work without really knowing if any of these options are going to serve the needs of the business owner. you need to have to work with a wealth advisor. Do I have enough money to do what I want to do? And that could be any number of things. What am I going to do the day after I sell a business? We just had a great speaker, the seller whisperer, Denise Logan, in last week with friends and clients, and she would say, saying I'm going to go golf or I'm going to travel, which are kind of the classic ones. That's not really a plan. That it's kind of sounds like a plan. I'm going to play more golf and you're going to travel, but where are you going to travel and where are you going to go first and second and third? You need to make a plan about what you're going to do. Otherwise, you're winging it a bit, and you want to feel really good about whatever choice you make, and you need to plan for that as emotional and as hard to start as that is sometimes.
Good.
Yeah, can I have three recommendations?
Yeah, you can have three.
Actually, well, one's a repeat of what I said earlier, and that is to consult your advisors, consult your banker, consult your accountant, consult your attorney, consult your wealth advisor. And if you're thinking about a sale, consult your investment banker, and make plans ahead of time. And then they in turn can give you the proper advice you really need. Beyond that, I would also, and I think Tony touched on this, have your management team be in place and be prepared to replace you, especially if you want to leave. If you want to leave immediately or even after a couple of years, have a team in place that's capable and credible to a buyer, and so that they're not viewing the business as being totally dependent on you, including introducing other key employees to your top customers if you're the key customer contact. And then third is put I'll call it your financial house in order, the business financials and your personal financial situation to be ready to receive that money. But on the business side, if you're just preparing tax returns now, maybe have a CPA firm prepare financial statements, even compiled or preferably reviewed or audited statements is a help. I mean, ultimately a buyer is going to do their own diligence, but it helps to have, financial statements that are more understandable from a buyer perspective, and not have to delve into explaining things. And that would include maybe taking out some of your personal expenses that inevitably all business owners tend to run through their business. While you can identify them and get them added back in the valuation, it's still better to begin to phase them out before you do the sale. And then, and this is more recent, the actual ultimate or the typical financial due diligence that's done by the buyers, it's what's called a quality of earnings analysis or report that's typically prepared by a CPA firm or some other independent firm. Quite often these days, while that's typically done by the buyer, the seller is ordering that report for themselves up front, to kind of prepare the business and the financial information in a format that's presentable to sellers. And Tony, are you seeing that as well, typically, or advising your clients to do that also more often?
Sometimes, and if they may not be doing, that exact quality of earnings report, but we're always going to spend time and understand the numbers and engage the CFO and the CPA to make sure that the numbers are gonna stand up to that due diligence process where the buyer is likely to hire a national firm who comes in and starts looking at cash flow in and out of bank accounts to $100 order of magnitude. So yes, you want to make sure that you have your financial house in order, so you can go through the process.
I'll quick share my screen. So this is just to highlight some of the information that a buyer is going to look for in the finances of the business. This is what the report will assess. You can see here, much more detailed breakdown of your revenue components, customers, length of customer, product lines, and the trends in those revenues. Look at those one-time expenses that are non-recurring that could be added back to EBITDA. Look at fixed versus variable costs and that breakdown. Just you can see some of this information here that's in that report. This isn't an audited financial statement. It's not, it's not concerned with making sure you're complying with GAAP, although you should ideally anyway. But these are some of the things that you should have your business be prepared to present to a buyer, because that's what they're going to be looking for. So that's my quick 2 cents or 3 cents. So, John?
Hey, Jamie, are there any other questions that are we on the right track in terms of what we're hitting here, or anything else that that we should address?
We don't have questions that have come up. I think, yeah, I like that last piece that you did, just going over all the options. We have about 5 minutes left for our scheduled time. So I'm going to post a survey in the chat for the people who are still with us.
So, Jamie, I didn't get to do my sort of 2 essential steps. So
got 5 minutes.
Okay, so number 1 is not leaving enough time in advance of the point where you wish to exit in order to prepare yourself financially to exit. So occasionally we'll get calls from someone who's about to sign a deal, or they're already in a process with an investment banker, and they haven't actually looked at their personal financials and what the personal financial consequences of selling the business might be. That's why I got into this business. I was sitting across from a gentleman who had sold his trucking company to a private equity roll-up, and he told me about going and shopping for a wealth advisor after the fact. And I'm sitting there and thinking about how much additional money he paid to every business owner's silent partner, who is Uncle Sam, for lack of advanced planning. He vastly overpaid his taxes. A smaller scale example is that every individual can gift at this year's rate $16,000 to a family member or anyone they wish. And that can also be used to gift business equity. So let's say we're thinking about someone who wants to transition their business to a family member. You can gift $16,000 worth of value every year. So that may not get you very far if you only have a year to do it. But if you start doing it multiple years in advance, you can start to move a significant chunk of the business equity over to a family member. And also, because it's a closely held business, you may in fact get a discount and can actually move more than $16,000 worth of value. You got to talk to your accountant about that. But you may be able to move closer, to, let's say, just for the purposes of argument, $25,000 of value on an annual basis to anyone you wish. So don't wait to the last minute is certainly number 1. And number 2 is stop focusing on the top line number. How much did I achieve for the sale of my business? Because that's not the number that matters. The number that ultimately matters is how much did you get to keep personally after paying your taxes. And only your wealth advisor can get in there and figure out ways to do it in a more efficient way. So.
Perfect. Great. I think Jamie, that's what I think that's a great wrap up.
Yeah, that's awesome. And then in terms of follow-up materials, some of the slides that were shown that spell the options out, that would be great if we could send that in the follow-up. Whatever you have available, send it over to me, and we'll make sure that all of the attendees and even the people who weren't able to make it, that they can have something as well. Sound good? Okay, well, thank you all so much for this presentation. It was very thorough. It is a topic that we haven't touched on for our SBDC clients in quite a bit, so it was really nice to have this refreshed material, and we really appreciate you. And thanks to everyone for joining today. If you have follow-up questions, I will include contact information, if that's okay with our panelists, in our follow-up email. Does that work?
Perfect.
Okay.
Jamie, thanks, gang. It was fun.
Thank you.
Yeah, thank you.
Thank
care.
you. Have a good rest of your day.
Thanks, everyone.
everyone.
Bye.